Gold. Gold's price is often not correlated with the price of stocks and other asset classes, making it a potentially useful asset to diversify a portfolio. Low correlation. Gold's price is often not correlated with the price of stocks and other asset classes, especially during periods of market stress. Hedge against inflation. Gold has historically maintained or increased its value over time, even when prices are rising. Safe haven. Gold is considered a safe haven when markets are declining because its price typically doesn't move with market prices. Inverse price movement. The price of gold is considered to move inversely to that of traditional asset classes. However, gold can also be risky because its price doesn't always go up, and it can be highly volatile. Gold is not an income-generating asset, and it requires storage and insurance costs. Investors can buy gold through exchange-traded funds or futures contracts. For example, SPDR Gold Shares is an ETF that represents 1/10 of an ounce of gold per share. Investors can buy or sell GLD shares on the New York Stock Exchange throughout the trading day. The primary variables that change the price of gold are supply and demand, interest rates, investor sentiment, geopolitical tensions, inflation levels, and the value of the US dollar. Essentially, gold is seen as a safe haven asset, so its price tends to rise during times of economic uncertainty or when investors are looking for a hedge against inflation or currency devaluation. Key points about gold price fluctuations. Supply and demand, the most fundamental factor, with increased demand and limited supply driving prices up. Investor sentiment. Market sentiment towards risk plays a significant role, with investors often buying gold during times of economic instability. Interest rates. Interest rates typically have an inverse relationship with gold prices, meaning higher interest rates can lead to lower gold prices. Geopolitical events. Political tensions and conflicts often trigger increased demand for gold as a safe haven. Inflation. High inflation can incentivize investors to buy gold as a hedge against currency devaluation and the US dollar. A strong US dollar can sometimes put downward pressure on gold prices.